Today, what I'd like to talk about is the outlook for the US economy and how it affects the Australian economy. There is a very good article published by the New York Federal Reserve on the 27th of March called "Fight the Pandemic, Save the Economy, Lessons from the 1918 Flu." This piece is a combined work between members of the New York Fed and the Federal Reserve Board in Washington, D.C. And what it does is it looks back through the literature of economics that have been published on this issue of the 1918 flu, going all the way back to 1927 and as recently as last month. What the article examines is the role of NPIs, or non-pharmaceutical interventions. Non-pharmaceutical interventions are what we're doing now. Things like quarantines and social distancing. And they look at what different cities in the US did and what was the effect of those actions of imposing non-pharmaceutical interventions was in those cities, and how that affected their recovery of manufacturing employment in following periods. Back then, GDP hadn't even been invented yet, so they measured everything in terms of manufacturing jobs. What they found was that US cities which adopted non-pharmaceutical intervention, quarantining and social distancing earlier, by doing things like closing theatres, closing churches, abandoning public meetings, and things like that, those cities were much more successful in recovering their previous level of employment after the epidemic had passed than those cities that started late with their interventions and didn't continue them for a long time when they did. So what that tells us is that based on this knowledge that we have of what happened in 1918, right now we're doing a really, really good job. And in fact, what we're doing is even better than the US is doing. What the effect, our non-pharmaceutical interventions in Australia are much more effective than is happening in the US. We know this by comparing the death rates. In Australia, the death rates from coronavirus are 1.65 per million people in Australia. In the US, it's 20 times as high, 33.2 people per million people in the US. And in New York City, it's 130 times the Australian level. So what that means is by the strategies that the Australian government has undertaken, by bringing people to work from home, to closing movie theatres, closing restaurants, closing churches, restricting large groups, what it has done, it has been able to limit the spread of the coronavirus to an even much more dramatic level than is the case in the US. And what's important about that is it means the Australian economy can rebound to this very rapidly after the emergency is over. In recent days, what we've seen the release of the first round of new forecasts by the Blue Chip Consensus, which is the leading forecasting firms in the United States, and their outlook for this year. And I have to say it's pretty tough. This quarter in the US economy, which is the second calendar quarter, is absolutely terrible. US GDP should finish this quarter 7% lower than it began. This is the biggest fall since GDP started being calculated, or the national accounts started being calculated in the US in 1948. This is the absolute worst quarter on record. What they expect will happen after that is that in the third quarter, output will stabilise and then begin a very rapid recovery. Growth should increase by about 6% annualised in the final quarter of this year. That's up 1.5% increase in GDP. But that really accelerates when we get into next year, where there should be a 4% increase in GDP in the first quarter of next year, 3.5% in the second quarter, 2.8% in the third quarter, and 1 and a bit in the final quarter, which normally would be a really good number. Now, what that means is, after last year's growth in the US economy of 2.3%, output should fall this year in the US by 5.4%. Again, that is the worst annual number on record. But then begins a major boom for the following 2 years. As people go back to work in the US economy, growth accelerates next year to 6.3%, which is the highest individual year on record, followed by 4.0% in 2022. Obviously, this kind of enormously rapid growth in the US economy will generate rapid growth in stock markets over the same period. Matter of fact, we expect stock markets to lead this economic growth. Well, if that's what's happening in the US, what happens in Australia? The problem is, we know that this quarter in Australia will be bad. We expect GDP in Australia to fall in the second quarter by 5%, but it really depends how rapidly we recover. If we recover very rapidly, that is to say, our workforce goes back to work really rapidly, then the loss in GDP this year will be very small. It could be as low as 0.5% of GDP, a very, very mild recession indeed. And that would be followed by growth next year of a bit over 3%, which is okay. But if our workforce doesn't go back to work until very late in the year or in the beginning of next year, then our output fall will be 5.6% of GDP. Now that means that next year we'll grow by 8%, but the growth is next year rather than this year. If we split the difference, what we think is that output will fall in Australia by about 3.1% this year, and then we'll accelerate to about 6% this year, 6% next year, followed by 2 and a bit the year after. So it all depends about when people go back to work. But what we know is that both in the US and Australia, we're having a severe slump this quarter. It will be the worst quarter on record since national accounts were started in both the US and in Australia. But following that, we think the Australian economy will recover and generate only a modest decline in output this year and rapid growth next year. We think that the US economy will still have a large drop in GDP this year, but a dramatic acceleration to over 6% next year and the year after. So what we've got tough times right now, but by the time we get into the second half of the year, we'll start to see the recovery of the economy, and next year especially, both the US and Australian economies will be growing at boom levels. Thank you.